Welcome to this special Talk Tickers edition of the Deep Dive.
Glad to be here.
Yeah, and if you look at the narratives dominating the markets lately, everything is just totally obsessed with the intangible, right?
Oh, absolutely. AI, large language models, the cloud.
Exactly. We treat all this new tech like it just exists purely in the ether, like it's, weightless and disconnected from physics.
Right, which is just completely detached from reality.
Yeah, I mean, if you actually look at how a massive data center works, the cloud isn't a cloud at all. It's a massive windowless fortress of concrete and steel sitting in a field somewhere.
It's incredibly heavy, and it generates just a terrifying amount of heat.
Right. And above all else, it is just relentlessly hungry for raw physical power.
Yeah, the physical footprint you need to run, virtual computing is just staggering today.
So that brings us to our mission for this deep dive. We're cutting through all the Wall Street jargon and breaking down Hubbell Inc's Q2 2026 earnings call.
Ticker symbol, HUBB.
Yep, HUBB. And for you, the retail investor, our goal is to be data forward, highly opinionated, and actionable. We're doing all this in a concise format to respect your time.
Because you don't need another lecture on how AI works.
Yeah.
You need to know how to trade it.
Right. So, okay, let's unpack this. Hubbell is not designing AI models. What do they actually do?
So they manufacture the critical electrical components, right? Utility solutions, high voltage transmission hardware.
Nuts and bolts stuff.
Exactly, but highly engineered nuts and bolts. The grounding systems that physically allow electricity to move from a power plant to a server rack without melting the entire grid.
Which is pretty important.
Yeah, I mean, the whole concept for their catalog is low cost of ownership, high cost of failure.
I like that. High cost of failure.
Right, because if you're building $1 billion data center, you are not buying your electrical insulators from the lowest bidder on some discount website.
No, because if a cheap connector fails, you're losing millions of dollars an hour in downtime.
Exactly. So customers pay a real premium for that engineering certainty.
And wow, you can really see that premium pricing power in their Q2 top-line numbers. I mean, they read more like a hypergrowth tech stock than, a 130-year-old industrial manufacturer.
The growth is honestly pretty rare for this sector.
Yeah, let's just rapid fire the data drop here. Net sales hit $1.712 billion in Q2. That is a 15% increase year over year.
Which is huge.
Organic growth was 10%. But the real standout, the electrical solutions segment, surged by a massive 18% organically.
Right, and that flowed straight to the bottom line.
It did. Adjusted earnings per share came in at $5.52. That's up 12% from last year.
Yeah, seeing an industrial business compound its top line at double digits organically, it really points to a structural shift in their end markets.
Not just a cyclical upswing.
Exactly. It's the sheer volume of product moving into this data center build-out phase.
But, okay, let's look a little closer at the margins. Because if you just skim the press release, the headline looks amazing, but there's some nuance here.
There definitely is.
Because despite that crazy 18% revenue growth in the electrical segment, their adjusted operating margins there actually shrank, right?
Yeah, they contracted by about 130 basis points.
Down to 21.2%, and overall company margins dipped slightly to 23.9%. So I have to ask, they crushed revenue, but margins shrank. Is this like getting an A on the test but losing points for messy handwriting, or is this a real problem?
It's definitely the messy handwriting scenario.
Okay, go.
Yeah, it's not that their pricing power is breaking. You have to look at the macro picture as that classic lag effect, right?
Between raw material inflation and when they can actually reprice contracts.
Exactly. Copper, aluminum, steel spot prices are volatile.
Right.
You can't just instantaneously rewrite every vendor contract the second copper spike.
Right. So you absorb the costs today and the price hike takes a quarter to show up on the income statement.
Yeah. And you also have tough year-over-year comparisons. Q2 of last year was kind of an unusual peak in profitability for them.
That makes sense.
But the real driver of the margin dip is intentional restructuring. They're investing roughly $20 million in restructuring this year. And a lot of that was front-loaded into the first half.
Mostly in the electrical segment, right?
Yep. Realigning the sales force, optimizing the manufacturing footprint.
Honestly, as an investor, I'd way rather see a company take a margin hit today to expand capacity rather than, artificially prop up a quarterly margin by underinvesting.
100%. And if you want proof that the business is healthy, just look at the free cash flow conversion.
Right, the metric that cuts through all the accounting noise.
Exactly. They're holding strong at around a 90% conversion rate of free cash flow to adjusted net income.
So for every dollar of profit they claim, 90 cents is physically hitting the bank account.
Yeah, generating $259 million in the first half of the year. In heavy manufacturing, keeping that cash generation while ramping up capital expenditures, it's a massive signal of health.
So to understand why margins dipped slightly while sales exploded, we really have to look at what they are selling right now.
Right, the two massive megatrends, grid modernization and the AI data center boom.
Let's talk data centers. Sales were up 65% in the quarter.
Which is staggering.
It is, and they bumped their full-year expectations for data centers to like 50% growth.
Yeah, and people assume this is just, well, more data centers means Hubbell sells more parts.
A rising tide lifts all boats kind of thing.
Exactly. But the engineering reality of these AI facilities is totally different. You're putting in these next-gen NVIDIA chips, and the thermal output and electrical draw just skyrocket.
Yeah, you can't run a facility pulling hundreds of megawatts on old electrical frameworks.
You'd have a catastrophic fire.
Yeah.
So Hubbell is engineering new pin and sleeve devices for higher amperages. They're basically enabling the shift to 800-volt infrastructure inside these buildings.
Because it's basic physics. More current means more heat in the wire.
Right, and if your connectors aren't rated for it, they literally melt.
Wow, so they're capturing more value per square foot because they're selling heavier duty, more expensive components.
Exactly. And let's not forget the utility side. The utility solutions segment posted double-digit growth too.
Which is usually just a predictable single-digit growth business, right?
Usually, yeah. Seeing double digits means the local grid architecture is under severe strain.
Well, yeah, you've got EV charging, industrial reshoring, the data centers, and underneath all that, the grid is literally decaying.
Aging wooden poles, transformers that are decades past their lifespan.
So utilities are playing defense, spending billions on grid hardening.
Which creates a solid floor for Hubbell. Even if AI spending paused tomorrow, utilities still have a multi-billion-dollar backlog of mandated maintenance.
So they have to buy this stuff no matter what the economy does.
Exactly.
Which brings us to the M&A side. We got to talk about the $3 billion acquisition of NSI that closed in June.
Yeah, that's a huge move.
Just looking at the raw data, it contributed $35 million in just a partial month, and they say it's going to add 20 cents in EPS in 2026 and 80 cents in 2027.
What's fascinating here is the strategic overlap. NSI brings in these niche brands, Bridgeport Fittings, Polaris.
Right, for conduit fittings and pre-insulated connectors.
Exactly. It lets Hubbell double down on network infrastructure. They can push their legacy products through NSI's distribution channels and vice versa.
But, and this is a big but, writing a $3 billion check means taking on debt. It pushed their pro forma leverage up to 2.9 times.
Yeah, which is the primary risk factor right now.
Right. A 2.9x leverage ratio leaves a lot less room for error, especially with elevated interest rates. It adds something like $170 million in net interest expense.
It does. But they used a mix of term loans, bonds, and commercial paper.
Why is the commercial paper important?
It gives them flexibility. They can aggressively pay down the principal using that strong free cash flow we talked about without getting hit by prepayment penalties you'd see on long-term bonds.
Ah, okay. So they plan to deleverage pretty quickly.
Yeah, they've committed to getting back to historical norms over the next 24 to 30 months.
Good to know. But we should also touch on how they are handling the broader macroeconomic issues, specifically the labor shortage.
No, this is such a crucial point.
Yeah, management mentioned this shift to modular solutions because work sites just don't have enough skilled labor anymore.
There aren't enough certified electricians and specialized welders to build all these data centers and upgrade the grid at the same time.
Right. So Hubbell is doing these PCX power skids, pre-building the components in their own factories where they can control the quality.
Yeah, they do the complex wiring, the testing, and then just ship a finished modular unit to the site.
I was thinking about it like, it's like buying a fully assembled high-end gaming PC instead of ordering a motherboard and a graphics card and trying to solder them together on your kitchen table.
That is the perfect analogy. And they're doing something similar on the utility side with these engineered crimping solutions.
Right, the German baker example, moving from welding to crimping.
Exactly. Connecting massive high-voltage bus bars used to require a certified welder, which is slow and weather-dependent.
And there's a huge shortage of welders.
Right, so Hubbell uses specialized hydraulic tools to permanently bond the metals with thousands of pounds of force. No heat required.
And you can train an entry-level worker to do that safely in like a few hours.
Exactly. They aren't just selling a connector, they're selling efficiency. They're solving the customer's timeline delays.
Which is why they're bumping up their capex to $175 to $190 million this year to expand their factory space. Customers are begging them to do the assembly work.
Yeah, the demand is just overwhelming.
And it's easy to look good in the rearview mirror, but how does this momentum carry into the rest of the year? Let's talk guidance.
The guidance raise was massive.
Almost unprecedented. They raised full year 2026 sales growth from the 8 to 11% range all the way up to 16 to 18%.
And even organic growth got bumped to 9 to 11%.
EPS outlook raised to $20.25, $20.55. That's an 11 to 13% growth rate. Why are they so confident?
Look at the utility segment's book-to-bill ratio. It's sitting at 1.2x.
Okay, let's break that math down for the listener. A 1.0 ratio means for every dollar of product you ship, you book $1 in new contracts. Steady state.
Right.
A 1.2x ratio means for every dollar leaving the factory, they are booking $1.20 in future business. They are taking in 20% more orders than they can currently ship.
Exactly. They booked roughly $2.4 billion in orders in the first half of the year alone. They physically cannot make it fast enough.
So this isn't a company hoping for sales. They have incredible visibility into 2027.
Yeah, especially with these massive transmission projects. We're talking 765 kilovolt and 550 kilovolt lines.
Not the wooden poles in your neighborhood.
No, these are the massive steel towers connecting remote AI data centers to distant nuclear or wind plants.
Right, because you can't just drop a 500 megawatt data center in a city.
The local grid would instantly collapse. And the engineering barriers for 765,000 volts are immense. You're dealing with the corona effect, dielectric breakdown. Yeah, you need absolute precision. Utilities won't risk buying from an unproven supplier when a failure could take out a multi-state grid.
So Hubbell essentially has a massive moat there.
Absolutely.
Okay, but we need to mention a very specific Q3 tailwind so people don't misread the upcoming earnings. The CFO mentioned a $20 million net benefit coming in Q3.
Right, the IE Bay tariff refunds.
Yeah. Basically, they've proven they were overcharged on import duties for raw materials, and the government is cutting them a $20 million rebate check.
Which drops straight to the bottom line in Q3.
But it's a one-time thing, so when the trading bots see Q3 margins spike, investors need to know not to model that forward into Q4.
Exactly. Management was very transparent about ring-fencing that benefit.
But even without it, they expect margin expansion in the back half of the year because they pushed a 1% price increase in April and another 0.5% in July.
Yeah, aiming for a 3 to 4% total pricing benefit for the year to fight off inflation.
So what does this all mean? We've got the data, the M&A, the guidance. What's the bottom line here for the retail investor?
I think we both take a highly bullish stance on this quarter.
Strongly bullish. Because, look, investors are terrified right now by the massive valuations of software and microchip stocks. It's so volatile.
Yeah, if a chip company misses revenue by 2%, the stock gaps down violently.
But Hubbell is the ultimate picks and shovels play for the AI gold rush.
I love that framing.
Right, like during the gold rush, the miners go broke, but the guy selling the shovels gets rich. Hubbell doesn't care if Microsoft or Google wins the AI war.
They don't care which language model is best.
Nope. They just know you can't run a data center without high-voltage infrastructure, pre-built power skids, and hardened grid connections.
And they have that downside protection. If AI spending slows down, they just pivot that manufacturing capacity back to their multi-decade utility backlog.
The basic grid maintenance.
Exactly. It provides a real structural floor for the stock.
Now, obviously, there are headwinds. The 2.9x leverage from the NSI deal is real. Inflation is real.
And their legacy commercial real estate exposure, right?
Yeah.
If the economy slides and nobody is building warehouses or office parks, they will feel it in their standard building components division.
True, but right now, the megatrends are just out-muscling those cyclical headwinds.
Without a doubt.
So I want to leave you, the listener, with a final provocative thought to mull over. We spend so much time talking about AI existing in the cloud,
Right.
But this earnings call proves that the cloud is incredibly heavy. It requires massive physical infrastructure, immense amounts of power, and literal nuts, bolts, and copper wires.
The digital world is completely bottlenecked by our ability to bend metal and pour concrete.
Exactly. So as you evaluate your portfolio, ask yourself, are you only investing in the software of the future, or are you also investing in the physical hardware required to actually turn it on?
That's the real question.
Thank you for joining this Talk Tickers Deep Dive. You are now the most informed investor in the room regarding Hubbell's Q2 results, and you got it all in under 5 minutes. We'll see you next time.